In this video, you're about to watch my interview with Danielle DiMartino Booth. She authored a book called Fed Up after she spent 9 years working for the Federal Reserve Bank of Dallas during the 2008 global financial crisis. And she actually served as an advisor to the president of the Dallas Fed at that time, Richard Fisher. Now Danielle is the CEO and chief strategist for her company called QI Research, a research and analytics firm. I have all of her information in the show notes, and I hope you enjoy the show. Danielle, I am so honored to be sharing the screen here with you. And I just have to tell you, I really appreciate your experience with macroeconomics and what's going on in the country right now. I mean, this is a really important, podcast. And thank you so much and welcome to our show.
Thank you for having me. We are definitely at a critical intersection, so to speak.
Danielle, the U.S. economy is not looking really good. And there's so many issues that are going on right now that are affecting Americans financially and will be in the coming months. And I don't think that many people are prepared what they really need to do to get through, what some economic experts believe will be something worse than the global financial crisis of 2008. And, I've heard many people even say that, depending on what happens over the next couple of months, what we may go through may even take us back and compared to the Great Depression back in 1929. And that was 10 years long. And before we go into, your opinions and recommendations on the current state of the economy, especially I want to talk about things as it relates to housing and jobs. Danielle, please tell everyone who you are, a little bit about your background working with the Dallas Federal Reserve, and what do you spend your days doing right now?
So I run QI Research. I was at the Federal Reserve Bank of Dallas for 9 years. I advised Richard Fisher on pretty much every aspect of the financial markets and the economy and how monetary policy, what the Fed does, how that played into how markets behaved, how the economy reacted. Before that, I was on Wall Street. I got my MBA in finance, and actually just like Richard Fisher, he was one of the few non-PhDs who was running a district Federal Reserve, kind of like Jay Powell's not a PhD in economics. He's more of a practitioner, more of a lawyer. But the important thing is that I kind of came at my position at the Fed after leaving Wall Street inside of a firm that was kind of a pioneer, if you will, in collateralized mortgage obligations. So I got to see basically the inside of the stuffing in the turkey, what formed the foundation of the housing bubble, the last one, and how that ended up culminating in a disaster for more than 10 million Americans lost their homes to foreclosure. So that is my context. That's my background. And it's how I approach running QI Research is the same way that I used to advise Richard Fisher. I see everything through the prism of how monetary policy interacts with the financial markets, interacts with the economy.
Yeah, well, I have to say, I read your book titled Fed Up. I highly recommend everybody to read it, actually. It really opened my eyes. And it seemed like regulators made some really bad decisions bailing out the U.S. economy back in 2008. And Danielle, from interviews I've heard with you, you've stated that the U.S. actually was heading into a recession in 2019, even before the pandemic. And, it's easy to Monday morning quarterback. We can always say, hindsight's crystal clear, 2020. But what mistakes were made during the global financial crisis? And I know you were in with the Dallas Fed during that time. And where were we actually headed in 2019 prior to the pandemic?
So I think that during the financial crisis and its aftermath, the biggest error that was made, chiefly by Ben Bernanke, and then his successor Janet Yellen, was fear. There was this ingrained fear of we can't let the economy stumble and fall. We have to do everything we can to prevent a down cycle. And what you end up doing when you pressed forward with the second round of quantitative easing, the second round of money printing, and then the third round. You ended up creating an environment where the bad players in the economy can subsist because the junk bond market is open. So instead of poor business models getting washed out of the system, they end up being on life support because the Federal Reserve kept interest rates at the zero bound, artificially repressed interest rates, and continued to grow its balance sheet. Now, that only worked for so long. And Jay Powell's first attempt, he came into office February the 4th, 2018. Jay Powell's first attempt to wean the economy off of the Fed's extraordinary policies ended up culminating in, along with a major trade war, ended up culminating in something my mentor, Dr. Lacey Hunt, has taught me, and that is we had a contraction in full year global trade. And when trade contracts for a full year in U.S. history, at least, the U.S. economy has been in recession. We were seeing a lot of the same patterns in late 2019 that we're seeing today. In other words, the number of states with rising jobless claims was blowing out. And we knew that we were headed into recession. And what I have maintained, and it's kind of a heretical take, if you will, is that the U.S. economy was forcibly closed in March of 2020. And it was also equally forcibly reopened because the first stimulus checks, the first round of the CARES Act, paying people an extra $2,500 a month to not work, those federal unemployment stipends, if you will, they hit American bank accounts on April the 15th, 2020. So my stance right now is that the U.S. economy has been in expansion since June of 2009. And if not for the extraordinary stimulus measures that were undertaken after the pandemic hit, we would have long since been in recession. But we know that fiscal stimulus continues to this day. But I'm of the mindset that we're 172 months into one of the longest, the longest recovery, technical expansion in U.S. history.
You know, you had mentioned in your book, Fed Up, that back in 2008, the FOMC had mostly, and you just mentioned, PhDs, but you said that most of these people had PhDs in economics, and actually they had earned their doctorates from some of America's top universities. So these are book smart people. When I look back then at, what ended up happening, a lot of the decisions that the FOMC made, really seem to have benefited the elite or their Wall Street businesses. And it seems like when I'm looking at, what happened with the pandemic and the dropping of the interest rate again to zero, pumping the economy, why is it that it seems like we're continually bailing out the elite? And I mean, is this intentional? I mean, these are smart people. Was this intentional to do, or is it where we are today just a result of just bad decisions?
Well, it's definitely a combination. To suggest that Alan Greenspan was not fascinated with being the popular boy after he was kind of the geeky kid growing up, but he became very popular on Wall Street because Wall Street figured it out pretty quickly after the crash of 1987 that, hey, the maestro's got my back and he's not going to let me suffer any losses. And that made him very, very popular in some very tight circles inside and outside of the Beltway. He was fascinated by that. And to that extent, it was kind of intentional. The flip side of it is these are really brilliant people. You cannot study econometrics without having a deep knowledge of calculus. You have to be smart, to your point. But did a lot of the economists not understand that trickle down was a myth? Yes. What we've seen over the past several decades is that the amount of money that CEOs pay themselves has gone up exponentially compared to what they'll pay the average worker. So the percent of corporate profits that are going to the workforce has declined appreciably over time. Share buybacks have exploded. That's a good way to pay yourself a nice bonus if you're Joe Q or Jan Q CEO. But I think that one of the fatal flaws of PhDs in economics is that they believe that if the economy is growing or if profits are filtering up to corporate America, that corporate America is going to somehow spend more on the worker bees of the economy and thereby everybody benefits. It's simply not how the real world works. Greed is real. And that's what we've seen manifest. And yet the Fed continues to try the same exact solutions every time. And the only thing that it really creates is a higher level of aggregate debt.
Do you think that Powell actually made decisions that were, I mean, I know you say they make similar decisions. And, I think, I think we can all agree now, it wasn't in America's best interest to, drop rates to zero and especially to keep them that way for such a long period of time. But it really wasn't a good idea for them to get into buying mortgage-backed securities. I think maybe that was 2012 or something like that, that they started doing that and, dropping mortgage rates to ridiculous, unrealistic levels, taking on that role in America. I mean, do you think that that Powell has made worse mistakes than Bernanke? Or, I mean, what's your opinion with that?
So it's interesting you ask, because it was the most hotly debated topic when I was inside the Fed. There were two biggies, right? The first was, we didn't see what asset price inflation was doing and how that would affect the economy, because the inflation measures that we track, they don't incorporate the stock market, the bond market. They don't properly account for runaway prices in housing. So that was kind of one of the conclusions and why I ended up writing Fed Up, because they recognized the flaw in the model and they did nothing to correct it. The other major debate internally was whether the Fed venturing into mortgage-backed securities, which is a form of credit easing, which violates the Federal Reserve Act of 1913. You're never supposed to choose winners and losers in the economy. You're never supposed to say, people in housing, home builders, they're going to win. Everybody else is to the detriment of everybody else. That's against the Federal Reserve's mandates. In fact, the Federal Reserve Act of 1913 specifically says that the Federal Reserve can never own a government-sponsored enterprise piece of paper. And yet here we are. What Powell, the reason the debate was so hot was we were concerned, this is in 08, 09, we were concerned that the Fed getting into mortgage-backed securities would depress mobility. That you would end up having people who were prisoners in their own home. So even if there was a better job halfway across the country, they wouldn't choose to take the job, which grows the economy, because they had these golden handcuffs. And of course, we lost. We were in the minority, people arguing against it. And what Jay Powell did in 2019, initially with the pivot, and then jumping back into full-blown quantitative easing and mortgage-backed securities on a scale, magnitude that had never been seen, what Jay Powell failed to recognize was that he could have gone the route at the time when the world was melting down. He could have, when the pandemic first struck, simply gone into treasuries with quantitative easing. He didn't. In fact, the pendulum swung the opposite direction. The Fed bought a third of the mortgage-backed securities market, a third. 60%, two-thirds of mortgages in this country are south of 4%. The golden handcuffs are real. The lack of mobility is exactly what we were concerned that it would be. And it's causing the stagnation in the economy to be worse than it would otherwise be. Because there are jobs out there, but a lot of Americans will not leave their homes.
You know, it is so true what you're saying. And as a real estate broker, I mean, I'm seeing this firsthand. I'm having conversations with sellers that are literally prisoners in their house because, and a lot of these sellers really can't even afford to be there right now. I mean, especially the ones over the last several years, a lot of them are so remorseful and, but they don't want to get rid of that rate. They're like, oh, I've got to hold on with all my might because of that. Do you know Jay Powell personally?
So I have never met Jay. Jay definitely knows who I am, but that's because he remains a very good friend of Richard Fisher's, and he saw many of the markets briefings that I wrote for Fisher over the years. So he's certainly familiar with my mindset and the work that I've done. But no, I've never met Jay Powell, and my biggest concern is his being out of touch. His net worth is north of $100 million. He worked in private equity for a good part of his career. He's a member of the Chevy Chase Country Club. Life's not bad. I think he's realizing it in retrospect. That does not go back and undo the damage that's been wrought on the U.S. housing market. And I don't think anybody's even really aware of how bad things are actually going to be. I'm good friends with Melody Wright, and she follows the mortgage market very closely. And just hearing her and knowing that November 2023 is the first month that Americans who've taken advantage of we don't ever talk about this in shared company. It's not polite, but there were a lot of extensions to the forbearance measures. So some Americans have not paid their mortgage since March of 2020. So November and there's a very, very high bar going forward to get another 12-month extension, very high bar. Melody's explained to me that you'd have to be God himself to get another extension. But when you look at the confluence of factors, that October's the first month that you had to start paying back your student loans, that November, for many Americans who are upside down in their homes, November is going to be the first month that they have to make that mortgage payment. We see disaster. You're familiar with the data. You know that at the peak of the last housing bubble, that FHA was south of 4% of mortgages being made. It's 17% today. There are a lot of people who've squeezed into homes that they cannot afford. The last thing they were expecting. Nobody explained escrow to them. They weren't expecting their insurance, their homeowner's insurance, to go through the roof. They weren't expecting property tax assessments to affect their mortgage despite their low mortgage rate. And they sure as heck didn't know what a 3-ton HVAC was going to be to replace. They have no idea. The HVAC's initial estimate when they're boiling in their homes and their air conditioning's gone out, they're like, you've got to be kidding me. That's the cost of a car a decade ago. So no, I think I don't think Jay Powell knows how bad off so many Americans are going to be, and or the speculation that he drove. I call them the Airbnb jocks. He does not know.
Danielle, there's so much. We could have a show on what you just said. It's so true. You are spot on. And I've been serving the housing industry since 1989. So a long time. I was a contractor. I was a home builder, long before I became a licensed agent or became a real estate broker. But I love Melody Wright. I've actually had her on my show. We had a live show with her and then a separate show podcast. And boy, I tell you, she's been hitting the road and she's been bringing it. And the frustrating thing is, and that's why I love listening to you so much, is because we're not hearing what's really going on. And I don't want to say that they're deliberately lying to us, because I do believe that a certain amount is like what you just referenced. The regulators, they're not struggling. They don't see the day-to-day things that, we see or hear when we're going into people's houses, when we're watching them not be able to fix the heating and air system. They can't fix the roof. and it's leaking, and now they have mold growing in their home, and they have kids in the house, and you know what, over 300, and this is so frustrating because you can't find the data. You have to dig for it so much, but over 300,000 people in the first quarter of this year continued to be bailed out of foreclosure, and with them extending FHA to 40-year mortgages, recasting balances, taking 30%. Biden signed that into effect, where now 30% of the balance of the defaulting mortgage can be put in a second mortgage at the end, interest-free. I mean, if they hadn't been doing this, we would be looking at a real disaster. I mean, do you believe that we are looking at something right now, or something that's coming, that could be worse than the '08 global financial crisis?
So it's a great big question. And I think that I can't fully answer it, but what I can tell you is that some analysis that I've just gone through shows that almost $700 billion of credit card and auto loans were extended that would not have been otherwise had there been a rental eviction moratorium and you didn't have to make your car payment for 12 months. Lending standards were deeply, deeply loosened. There were banks that were told quietly, if somebody can demonstrate that they've received a stimulus check, go ahead and make them the loan and substitute that out for income verification. I mean, makes your eyes roll into the back of your head to think about the implications. And this was spread out across autos, cars, and homes. And then the current administration came in and they said to the lenders, by the way, we sure would appreciate it if you would be inclusive in your lending standards as well. It's nobody, it does nobody any favors to take on more than they can afford. Repossessions right now, car repossessions, the number of people in that industry, the number of workers in that industry is down by about 25%. So they're only repossessing as many cars as they can. They'd be repossessing more if they had, and it's also a dangerous profession. I mean, repo men are literally getting shot at.
Oh man.
They are. I mean, Google car repossession, and what you're going to see if you hit Google News is a bunch of local TV stations reporting about this person or that person getting shot at when they tried to repossess a car. The loan to value on car loans is about 140, 150% in many cases, and the cars are not running. A lot of them have simply broken down. The reason I bring this up is because there was a cohort of Americans who fled the city, bought a house in the suburbs or the exurbs, squeezed into the mortgage payment. They had to buy a car for the first time. They couldn't exactly take the subway that didn't exist in the exurbs to the grocery store. So they have an overpriced car. Their car insurance, in some cases, exceeds their payment today. And they're also homeowners. And they make enough to have bought the house and bought the car, but they make so much they don't qualify for student loan forgiveness. They make north of $60,000. I worry about the percentage in the middle. I'm going to throw something out to you. I looked at a particular credit union's their loan portfolio, specifically for their cars. This is just to give you an idea. When their loans were originally underwritten, only about, well, I can't use hard numbers because anyways. From when they underwrote those car loans to today, there's been a 12-fold increase in credit migration out of prime into subprime of existing loans. So think about that for a minute. Credit ratings were so inflated by the stimulus measures that were taken that since the stimulus measures have disappeared, credit card debt has exploded, and there's been a 12-fold increase in people migrating back into the subprime buckets. Capital One Financial walked away from car loans in June of 2022. it is still writing off a ton of auto loan debt and credit card debt. What we don't see is housing yet, because the forbearance existed for longer than any other type of debt that American households had taken on. So all we can do is look through the prism of other types of debt to get a feel for where we're headed with the housing industry plus the Airbnb jocks.
Well, I know firsthand, and I've said this for quite some time, the government bailouts has been the only thing that's kept the inventory one of the things that's kept inventory so low, because people are in their homes that, really wouldn't be had there not been for so much bailout. COVID-19 money started, like you said, 2020. Some of these people, 2019, were behind. It was very, little to prove that their financial distress was because of COVID. I think they only had to mention that. But one of the things that I've said, and I get so much pushback because I'm trying to tell everybody what I'm seeing, and all I hear is, you're wrong. Your housing is only going to go up. And I know that one of the reasons why we haven't seen such a major fallout of the people that are paying their mortgages is because the job market has appeared to be relatively strong. I think until now. And, but I can tell you that with the rising cost of businesses right now, the lack of business credit that we're seeing, coupled with the fact that consumers are really now backing off of discretionary spending. Danielle, I heard you say recently that we should be preparing our households for a spouse losing their job. And I also hear you all, referencing a lot, and I've been visiting it. And it's true. I'm seeing more and more every day. I think it's dailyjobcuts.com, is publishing, what's happening. How concerned should we be regarding job loss now in the U.S.? I mean, with all this debt. And, if you had to guess, how high would you expect unemployment rates to reach before we actually get out of this mess?
So, it's interesting because, the founder of dailyjobcuts.com, I've gotten to know him over the last few years. And the thing that alarms him the most is the steadiness of the closures that he's seeing. And to take but one example, yesterday, there were 17 announcements of closings yesterday. One of the announcements of the closings was 65 hospitals that had shut down departments or stopped providing services. One of the other of the 17 closings was Z Gallery, which has declared bankruptcy for a third time in a row. It's closing 21 stores. There were 12 companies yesterday that announced layoffs. One big bankruptcy. One day. This is just one day. But the thing is, here's a little bit of dirty laundry that I've never actually shared on a podcast. It used to be the case that if you were company ABZ and you were laying off, say, 50 people in Maryland and 50 people in California, that you wouldn't actually have to, as the employer, file a WARN notice because you were under the 100 employee threshold that requires you by law to let the state know that you're going to be moving forward with layoffs. What the current administration has done is require that if you're company ABZ and you're going to lay off 100 people, they don't care if it's in 10 states, you've got to file the WARN notices. What do WARN notices do? WARN notices give the employee 60 to 90 days of severance to look for a job. So there's a pig in the python that's never occurred in prior cycles that's artificially repressing, if you will, the jobless claims numbers that many people in my world continue to reference as being so strong. There's an artificial repression of this on top of Yellow Trucking going out of business a few months ago. And that was 30,000 employees who got paid severance for months. We haven't seen them show up in the data, but the data is coming. Economists talk about the difference between non-farm payrolls, the number of jobs created, and the household survey. Why are these two surveys so far apart? Well, if you've been told that you're going to get laid off and you pick up the phone, and not that anybody does, or however the Bureau of Labor Statistics reaches out to people, the household's going to say, I don't have a job. I've been fired. I'm collecting severance, fine, but that doesn't mean that I think I have a job. I know the company's not going to call me back up and say, come back to work after 60 or 90 days. But if you call the employer, that person's technically on their payroll. They're going to say, I've got this many workers. And it's not until they're off the payroll and they stop paying severance that they're going to say that this person is no longer an employee. So there's a lot of mud in the data. And there's a lot that we don't see that's actually occurring out there. But I talk to everybody in all walks of life. And I was in Las Vegas recently. I was just speaking to an everyday person who was lamenting that she had a rental property in Tampa Bay and that she was fine with the one long-term lease on half of the duplex. But boy, she couldn't rent it out on the other side. And she was worried she was going to be foreclosed on. And she was just hoping that she could turn her duplex into 2 long-term leases instead of 1 long-term lease and 1 short-term rental. She's not alone.
Yeah, we see it. You know, you spoke earlier about Dr. Lacey Hunt. You know, one of my favorite videos and interviews with you is one that you did, and he's your mentor. I love that. And to anyone that's interested in watching it, I'll drop the link here in the show notes. I tell you, I recommend everybody taking the hour and watching this. But, you know, you were really sharing insights, not only on your experience with macroeconomics, but what was really happening with the job market. And, you know, I hear all of this nonsense about, I see all these job postings and then when I dive into it and I learn that a lot of them are part-time jobs. So we're trading in full-time jobs for part-time jobs. And they want to come out and say, well, the jobs report is so great. You know, you and Dr. Hunt were talking back and forth about, I think it was 7 recent negative revisions to non-farm payroll. And you also said that this payroll data or the information is not just lagging, but not complete. And we're not really hearing the real statistics. And, you know, and I believe, I mean, one of the reasons I'm mentioning this is I believe that unless we start really educating Americans on where we are, I mean, this could be catastrophic if we wake up one day and you're talking about the revisions and all of a sudden we get this massive revision of the truth. Can you kind of explain what you and Dr. Lacey Hunt were talking about in layman's terms regarding wage decline, that 7, periods?
So when it comes first to job openings, ironically, it was 2 staff papers, one from the St. Louis Fed, one from the Dallas Fed, that showed that 90% of job postings, and they attached big data to it. 90% of job postings that are out there are written so that you can poach your competitor's best employee, which means that you get your competitor's best employee is now your best employee, and you don't have to train him. So you save on the cost. So the job postings exist, but they're not for new entrants to the workforce. They're for people who already have a job, which does not generate squat. Now, revisions are interesting because when I spoke with Lacey last time, we'd had 7 negative revisions in a row. We had never had that documented, with the 2 exceptions of after having emerged from the double dip recession that ended in 1981, after the recession had ended, and in 2009, after the Great Recession had ended. Those are the only two other presidents. And, you know, I'll just say it. I think there's some level of corruption in our data agencies right now, and the data can't be that wrong. It cannot disconnect so much with announcements of companies that they're closing and firing people. They don't vanish into thin air. It's not a figment of our collective imagination. But subsequent to the link that you're going to drop with me and Lacey, we found out that July and August actually had positive revisions to the tune of, I think, 110,000 employees, all government workers. For the private payrolls, they were revised down by 12,000 for those 2 months, extending the run to 9 months. I'm a huge patriot. My sophomore in college, he graduated from Culver Military Academy. I've got 2 sophomores and a senior at Culver Military Academy. I love my country. I stand for my flag. I do. But when the data begins to make somebody who was working in the Soviet Unions, in the USSR, when it makes somebody from that era blush because it's so obviously corrupted, you get concerned, because we are a country where there should be transparency in data and it shouldn't be glossed over. So there are some serious concerns right now with the data that we're seeing and with a lot of the fraud that's occurred. We could speak for a whole half hour about the employee retention credit. Let's just say that I'm happy that it's on pause right now, and I hope that the IRS ends up canceling it because it lined the pockets of high net worth people to begin with who were making fraudulent claims. But our government is just not in a good place right now, and it's not making policies that are going to safeguard the long-term health of the United States. And I hope that changes.
Well, as a patriot, I commend you on your courage. And I think, and that's one of the reasons why I think everybody should also read your book, because, you probably thought long and hard after you wrote that book on, is this a good idea? Should I do it? Shouldn't I do it? But so I really thank you on that. But let's turn our attention, if we can, just to, kind of talk about the housing market, because obviously, talking about wages, the growth hasn't kept up with home prices that have literally doubled since 2019. And historically, I don't think we've ever seen anything like this housing market where it's been so unaffordable since post-World War II. And, in most markets, I think now it's cheaper to rent than own, and I don't want to go down I have so many other questions I want to just ask and touch on, but, everybody's talking about the World Economic Forum. I get a lot of comments on my channel where people are like, oh, this is all part of the plan, rent and be happy. Do you think that we are in for a major housing crash?
Well, because you bring up the fact that it is so much more economical to rent. I'm good friends with Ivy Zellman. She has proprietary data on many things, many aspects. One of them is a monthly apartment operator survey that she runs. And in terms of pricing power, you've got 2 cities in America right now, Philadelphia and Chicago, that have pricing power in their apartment market. And that's because developers didn't go there because they were crime-ridden. But anywhere else where the 1.2 million units that's come on in the last 3 years, in addition to the 1 million units in the pipeline of apartments, tells you that Americans are, home buying conditions have never been as low as they are. And yet home sellers are still being told by way too many realtors to hold out for a higher price. But home buyers don't have to. They don't. And I think that the buyer's strike is going to be a very real thing because apartment renting is so much cheaper on a relative basis. And you're talking about luxury units, first month free, last month free, blah, 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 incentives to try and get people in the door. Rental appreciation for new move-ins is below where it was in the third quarter of 2019. End of story. So I do think that housing is going to be in a severe and protracted correction.
It's interesting. You said that buyers are on strike or will go on strike. They're on strike. I'm talking to them. I get so many buyers that reach out to me all over the country because of our show. And they're slamming their foot down. And they are commanding the show right now. We are seeing higher contract cancellations than we've ever seen. I think 16% is what they're saying, the national average. In Atlanta, Georgia, it's almost 25% in September of the contracts to purchase were just flat out canceled. And a lot of these buyers, and you're right. I mean, a lot of the problem is in my own industry. I mean, the cheerleading, the date the rate, don't worry about it. And one of the things that I want to kind of ask you is that, I mean, Barbara Corcoran, obviously, you know who she is. I mean, look, Danielle, she's going out and saying, I mean, talk about being out of touch. She's actually saying, guys, don't stop buying, because when interest rates drop back down and have a 5 in front of them, home prices are going to soar, is exactly what she said. And she said, they're going to go up 20%. And I'm going, well, I don't think that we can afford this. And, and that's why somehow in the back of my mind, I'm saying, we're looking at, it said that 1 in 4 single family houses are, owned by institutional investors. And, you can thank the crisis, the global financial crisis for that. All of those, homes were bundled up, fed to Wall Street. They got their fangs in what it is like to be in residential housing. And, they've seen nothing but good times. And, since they bought on nickels on the dollar, some experts are actually saying that by 2030, 40% of the single family homes will be owned by institutional investors. I mean, what do you say about, Barbara Corcoran cheerleading? And, do you think that it's a possibility that we just won't have any affordable single family houses?
Well, I mean, bless her heart. She's talking her book that's never happened before. I think that, I'm trying not to be too political here. I think that there are a lot of Americans who are younger than me, don't like to pay their bills. And I think that quite a few of them might vote so that they don't have to pay their bills. And if the government starts to hand out stimulus checks the same way that it did after the pandemic hit, which was basically a test study of universal basic income that failed, I think that if that happens, we could see runaway inflation. I mean, the dollar would get destroyed. The country would be destroyed. Everything would be destroyed. Everything as we know it would go to hell in a handbasket. I hope that doesn't happen, because I want my children to grow up here and have children. And but as things stand today, if cooler heads prevail in Washington, D.C., there's no way in hell prices are going to go up 40%.
What advice do you have for someone that is on the sidelines right now, hoping rent? I mean, I heard you say, wait. I think one interview you said wait till 2025 or just kind of hold off. I mean, are you thinking that things will be better by then?
I think that a lot's going to occur between now and 2025. 2025 is a critical milestone on the calendar, because if there is a blue wave, or if Donald Trump wins the election, because he invented socialism in America, that was the CARES Act. So, but the reason I bring that up is because the soonest we're going to see that type of stimulus is March of 2025. It's a long way between now and then. And between now and then, there's not going to be any helicopter money distributed to U.S. households. And that means that the household default cycle is finally arriving. Finally. Even by next October, there'll be millions of Americans who are either going to declare bankruptcy or start repaying their student loans. If right now they're not paying them because it doesn't go on their credit report, it's coming. So there just aren't places to hide right now. If you're a U.S. household, you're either going to make good or you're going to default. And for a lot of Americans, they're going to end up defaulting. And by the way, for so many, through no fault of their own. When they bought that new home in July of 2022 and the home builder bought down the rate, they believed that a year later, in July of 2023, that mortgage rates would certainly not have gone up, but yet they have. So this is going to force a lot of hands. And it's a tragedy that it's going to force a lot of hands because people were hoodwinked into thinking that you can date the rate. And by the way, if mortgage prices come back down to 5%, that means that the Fed's panicked because we're in a deep recession. So one thing over all things trumps mortgage rates, and that's whether or not you have a job.
Well, we thank you so much for your time. I mean, we could talk to you for hours on end. And Danielle, why don't you tell everybody, I mean, how can they follow you? You know, we'll drop the links below. I mean, tell everybody how they can reach out.
So at QI Research, 2025 is our 10-year anniversary. Wow. But we publish every day. And we actually have a very reasonable a newsletter that goes out every trading day for $59 a month. My institutional clients scream because it's too cheap, but it is what it is. So come find me, DiMartinoBooth.substack.com, DiMartinoBooth.substack.com. And if you don't already follow me on Twitter, then you got to get out more. So follow me at DiMartinoBooth because it's always entertaining. And by the way, if you're wondering, yes, I'm being sarcastic.
Well, look, I can't thank you enough. Thank you so much. I hope that we get to do it again someday in the future. And we'll talk to you soon.
Thank you. I appreciate your time. Good talk.
Well, I could have spoken with Danielle for hours upon hours, and I think she's very knowledgeable. Obviously, I hope that you felt the same. If you liked the video, you can smash that thumbs up and let Danielle and I both know that you did. And guys, cruise on over to Danielle, subscribe to her channel. She puts out great content just like our interview. And if you're not subscribed to our channel, maybe take a moment and do so now. Hit the alert bell. You'll be notified every time we upload content. But guys, the biggest favor really that I need to ask of you right now is that this information is so important and we're not hearing it in mainstream media. If you would do me a personal favor and share this with at least another person, one of your friends or family members that should be aware of what's really going on. See you next time. Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.